When you analyze the financials, please pay attention to the figure called investments, especially those that are sitting under non-current assets. Let's try to have a flow. See, in business, funds come from owners, funds come from outsiders. And using these funds, we'll be creating current assets, fixed assets, other non-current assets. But when fund come in this route, and if a good amount of the fund is going to other non-current assets, especially in the form of investments or say loans and advances to sister concerns, to associate units, to subsidiaries, joint ventures, you have to pay attention. See, if you take infrastructure companies, they'll have various subsidiaries to undertake separate projects. Okay, that is fine, normal. Whereas in other business, if they are having too many investments in subsidiaries or sister concerns, you have to look at it with wider lens. Why they are making so much of investments? Because whenever money goes out in the name of investment, the likelihood of those money coming back to the entity is very remote, and this is going to affect the net worth as well. And in many cases, in many scenarios, this has been used as a funnel or the loophole to take the money, suck it out of the system. Okay, so whenever the money goes out in the name of investments in other business units, you have to understand how long this investment is going to stay, what is the likelihood it will come back, whether it is going to generate any revenue for this business in future or not. If not, then this has to be adjusted against tangible net worth. We call it as after adjustment we call it as adjusted tangible net worth, and this should be compared with the total outside liabilities to know what is the exact long term solvency of the business.